Hello, everyone. I'm Susan Sarava with Comerica's marketing team, and this is an economic and market update. I'm joined by our Chief Investment Officer, John Lynch, and our Chief Economist, Bill Adams. Welcome to both of you.
Thank you, Susan.
Hi, Susan.
Hi there. Glad to have you here. Well, I know you two have been closely monitoring the situation in Ukraine. It's a very difficult situation for anyone in that region. And we want to talk today about the implications on our economy and also the market with what is happening. So, John, let's go ahead and start with you. Tell us what's been happening with the markets leading up to today and what happened.
Thank you, Susan, and good afternoon, everybody. It's always so challenging when you have an undeniable human tragedy. You have to separate that and see what the market implication is. This is the life I've chosen, so I'm always prepared to do that. But nonetheless, you always want to be very, very mindful of that, not be dismissive of the human tragedy. But nonetheless, leading up to today, obviously, there's been a lot of saber rattling earlier this week. Vladimir Putin recognized 2 breakaway separatist regions, sent troops in. But the real trouble started early this morning or last night with, shooting, and it now appears Kiev could fall within a matter of hours. I do think it's very important to keep in mind as investors not to be swayed by headlines, not to be swayed by geopolitical events, because what we have here on the chart shows that we looked at 16 or 17 different events since 1950. And what we found is the market reaction to geopolitical crises tend to be swift, initially a big hit, and then surprisingly within a month, the market recovers all that it's lost. So if you typically see market down, call it 1% on the first day of the event, maybe 5% down within 10 or 11 trading days of that event, but a month later, the market has recovered those losses. So I think that sort of perspective is necessary. That pattern has been magnified today because I'm looking at a market now that is closing up 1.5% on the S&P 500 and the NASDAQ is up 3%. So not sure I fully understand why that is. I've been at this for 35 years and I'll need another few centuries to be able to figure it out. But I believe what happened today is the market, quite frankly, heard what it wanted to hear relative to the sanctions. And we'll ask Bill for some insight there in a moment or two. But I do believe that what happened this afternoon with the rapid response in the market, I don't think the sanctions were that significant that should have turned the market on a dime. But nonetheless, the market is a discounting mechanism. So what we have here in this chart shows that the market reaction tends to be swift and furious. And today that's been on steroids with a very quick recovery over the last 2 hours.
Okay. Good to know, John. All right. So, Bill, let's go to you. Now, heavier sanctions were issued just within the last hour and a half or so. So how do you think that those will affect the situation in our economy?
Thanks, Susan. So I think the sanctions and their effect, I think, are probably not going to have a huge direct effect on the U.S. economy. U.S. Trade with Russia or with Ukraine, Russia-Ukraine combined, is our exports to them are less than 0.05% of U.S. GDP. So the trade with Russia or the ability to use trade with Russia as to influence Russia just from the U.S. was pretty limited. Having a broad coalition imposing sanctions on Russia, I think, will have a significant impact on the Russian economy. But I think and maybe here is the explanation for John and I were talking about this before we went live. My hunch is that why markets have interpreted the sanctions as in the way that they have is that there is this carve out in the sanctions for Russia to continue to ship energy to Western Europe and to continue to receive payments for those energy shipments. And thinking beyond the political or the human costs of this conflict and focusing specifically on the economic side, one of the big ways in which this could have hurt the global economy is that Russia is a big supplier of natural gas to Western Europe. It's still winter. Western Europe needs natural gas to keep homes heated, to keep industry running, keep electricity flowing. And the sanctions that are imposed on Russia, while they will have a severe impact on the supply of goods in Russia, they're not going to prevent Russia from shipping energy to Western Europe. So, and that Western Europe is a huge portion of the global economy, and that means that we're not going to see an energy crisis, most likely in Western Europe, and we're not going to see a recession driven specifically by energy as a result.
Okay. All right, John, let's go back to you now. And I wanted to ask you about, if this correction were to get worse, tell us what, and in bear territory, what kind of trends could you see?
Yeah, I think importantly, if you kindly move to the next chart, it's important to recognize that the market during crisis events tends to reinforce existing trends when you're in a crisis event, okay? And I think that's so very important. So before we really discuss correction, if you will, I think it's important to characterize crisis events don't typically alter a market trend. And we've basically seen this really since September, magnified in November. And from November on, even though we've had the Omicron variant and many other issues with inflation, with a Federal Reserve that's pivoting on policy, and the saber rattling now, the invasion, I think when you look at market trends, whether you look at what we have here, the chart up, the average stock outperforming the index, the S&P equal weighted index has been outperforming the cap weighted index. Another chart that's very important to look at is the S&P growth index relative to the S&P value index, and the trend for value that's been outperforming really since September, magnified since November, has come into play up until about 2 hours ago. But I do think that the trend nonetheless is that value is going to outperform growth. Equal weight is going to outperform the cap weighted index. Those are market signals supportive of a cyclical recovery. Whether you look at the 10-year Treasury, perhaps on the next chart, the 10-year Treasury yield has been clearly a market signal that rates are headed higher. And we may see a 10-year back up a little bit. We'll call it 195 or so at today's close. I think there's a fair amount of support for the 10-year Treasury yield in that 175 range. Nonetheless, if you look at global rates, negative yielding rates have declined from more than 15 trillion to approximately 5 trillion. The Japanese yen, Japanese government bond, the JGB, has been climbing. The Bund, the German Bund, rallied today. The bond rallied, but the yield has been climbing for the better part of 3 or 4 months now. So the global trend for higher rates is undeniable, and I think that is a trend that will only be reinforced when you think about, as Bill just highlighted, the potential for higher energy inflation in Europe. So I think you're going to see that. And then finally, gold. Gold prices have been moving higher also. Since gold broke out of the 1875 range 2 or 3 weeks ago, we've seen gold prior to 2 hours ago when the market rallied and gold sold off. Nonetheless, I think you're going to see a market signal talking about or signaling support for the global cyclical recovery, even if stocks correct because of headlines.
Okay. Thanks to everybody who's watching us on LinkedIn right now. If you have any questions for John or Bill, just go ahead and put them in the comments and I'll take a look at those. Let's talk about interest rates. We know the Fed is meeting next month. Bill, I'll ask you first. Does this change the action you expect by the Fed for this next meeting and the rest of the year?
I think it does change the the possibilities for the March meeting. Prior to the Russian invasion, I've been thinking of the interest rate decision in March as kind of a coin toss between them hiking by a 1/4 percentage point or hiking by a 1/2 percentage point. After this invasion, I think that the 1/2 percentage point hike was, that's not a tool they've used in recent memory at the Fed, and it's seen as sort of a more extreme response to try to raise interest rates so quickly. I think they're much less likely to do that. I think the bar to make a 1/2 percentage point interest rate hike in March, we'd have to see a really surprising jobs report at the beginning of March, showing the labor market dramatically tightening the unemployment rate, I don't know, coming down to 3.5% or lower. I think for a 1/2 percentage point hike to get back on the table. Much more likely, I think they raise interest rates by a 1/4 percentage point in March. Then we probably will see additional rate hikes at perhaps May and June, September and December. So I think cumulatively we could see short-term interest rates going up by 1.25% by the end of this year. And the Fed is also likely to announce the beginning of reducing the size of their balance sheet, probably in the 4th quarter of this year, sometime in either October or maybe even in September, if it turns out that the Russia-Ukraine crisis ends up having fairly limited effects on the U.S. economy.
Okay. And John, is the market just going to make those assumptions about the interest rate that Bill just mentioned, do you think?
Well, today is a great example because, Bill and I agree that the Fed will be less aggressive than the market has priced in recent weeks. And when you see the NASDAQ composite rally by 3.3% going into the close this afternoon, that is a market saying the Fed won't be as aggressive as investors have believed. Nonetheless, we still think the market is positioning for a cyclical recovery. But even with the late day rally, the S&P 500 is still in correction mode. And I think it's appropriate to point out to our viewers that corrections are a normal part of business, right? And we've seen over 30 corrections in the past 40 years, going back to 1980. The average pullback is about 18%. And, we're down 10%, right? And our stomachs are turning. So I think it's important to recognize, and even midterm election years, you typically see a 17% correction. But once you hit that 17% or whatever the trough is during a midterm election year, if you adhere to your long-term strategies, you'll notice that the S&P 500 has historically rallied by 1/3 on average from the trough 12 months later. And if you think about the correction data that I just talked about, 30 corrections over the past 40 years, average decline 18%. From the trough, 12 months thereafter, the market is up by 25%. And 2 years later from the trough, the market is up by more than 1/3. So I think those are important data points that investors need to appreciate during volatile times such as these.
Well, that does put it into perspective, but it is jolting, I'm sure, for investors today to see what happened, given the growth that we've had over the past, 20 months or so.
Absolutely, absolutely. And that's why I think it's so important for investors to recognize. And that's why, I had that chart earlier about the average stock outperforming the S&P equal weighted versus the S&P cap weighted. The S&P cap weighted index is the more popular one. And that's really been driven for much of the past 2 years by, the big five technology, if you will, FANG plus. And now that you're seeing the average stock outperform and those big five tech, those growthier names struggle on the prospect of higher inflation, higher interest rates, those are longer duration assets, meaning investors pay up for those assets for the longer term opportunity in their profitability. And shorter term profit groups like value, for example, investors don't pay as much for those, so they're more reasonably priced. And I think that, again, more supportive of the cyclical economic recovery, and I think a good technical charts, not only fundamentally a positive backdrop for investors, but also technically a fundamental backdrop for investors when you're looking at the average stock outperforming the overall index.
Okay, Bill, is there anything you can add about expectations for gas prices at the pumps for us here in the States?
I think a crisis like this is probably going to keep energy prices higher than they were before the fear of a Russian invasion kind of got on any of our radar. And higher gas prices are going to mean higher inflation in 2022. This comes after inflation was the highest in 40 years in 2021. So I think it's more bad news for consumer purchasing power. I think the silver lining there is that consumers have, American households have saved more than $2 trillion worth of excess savings above the normal rate of savings since the pandemic began in 2020. And so there's more of a financial cushion in American households to absorb an increase in energy prices and then keep other parts of consumption, other parts of the economy still going. So even with a drag from higher energy prices on consumer spending this year, we still think that we can get a very solid year of economic growth with U.S. real GDP likely up over 3% over the course of the year, and the unemployment rate falling from 4% at the beginning of the year to probably around 3.5% by the end of the year.
Okay, well, that's certainly positive. Okay, before we wrap things up, just want to ask any final comments. John, I'll ask you first. Any final comments you want to make?
Yeah, I just encourage investors to look at the data points we presented you with today. I'm not necessarily pleased with the market's late day rally because I'm not sure it fully really embraces all the challenges that particularly Europe is facing right now. But nonetheless, despite the shorter term challenges that I see for the markets, I do think longer term full year returns, I still think, as Bill pointed out, 4%-ish, high 3%-ish GDP growth. We still think corporate profits can rise in that 8 to 10% range. And I still believe that the cyclical recovery is intact. We're going to position for value over growth, profitable small caps over large, and still look at earnings and income as the primary driver for total return this year, not looking at PE expansion. But I still believe the S&P 500 would be fairly valued in that 5,000 range. So there is a reason for investors to remain invested in spite of the many geopolitical tensions that are facing us currently.
Okay. Bill, I just want to ask you real quick. I see on LinkedIn, that's why I'm looking over this way. I have my other laptop here on LinkedIn, and we do have a question from Rich, and he's asking, what is the long-term outlook on inflation? So we talked about it kind of for this year, but what do you expect in long-term for inflation?
I think looking into 2023 and 2024, I would expect inflation to be slowing pretty dramatically. Again, what's driven up inflation last year and this year to a very large extent was energy prices, and then prices of durable consumer goods like cars, used in new cars, and a lot of those are tied to supply chain disruptions, which business surveys show are already starting to improve in early 2022. So as supply chains open up and there are fewer shortages of consumer goods, fewer shortages of the components that manufacturers use to make those consumer goods, that should translate into slower inflation next year and the year beyond. Other trends I think are also supportive of inflation moderating. Fiscal policy in the United States is normalizing, so that's going to be less of a boost to domestic demand. That is also consistent with inflation slowing. And I think we're going to see a return of more American workers to the labor force as fears about the coronavirus continue to fade. That's likely to keep inflation lower as well, since the labor shortages, which contributed to inflation this year, will improve as labor force participation rises.
All right, that makes a lot of sense. And Bill, any other final comments that you'd like to make?
Obviously big downside risks to the global economy from this crisis, but like John, I don't want to downplay it, but I also think it's worth emphasizing that the direct economic impact on the U.S. is probably going to be limited to the pass-through of higher energy prices and other kind of financial transmission. So I think the U.S. outlook is still pretty solid, and I think the U.S. economy is going to continue to make good strides this year in recovering from the after effects of the pandemic.
All righty. Well, thank you both, Bill and John. Thanks so much for joining us today. And thanks to all of you who are watching us on LinkedIn, and hope you have a great rest of your day.
Thanks, everyone.
Thank you.